This is a not about two brothers like the Hunts trying to corner a market. And the interesting thing is, it's the same situation. The Hunt brothers noticed that there were more paper contracts than there were bars behind it. So let's buy the paper, stand for delivery. That ain't what this is about anymore. This is about some of the biggest, most well-informed money in the world that is making a rush to accumulate a metal that is finally being admitted as strategic, not just industrial, and arguably worth more than the dollars used to purchase it. And what started out very quietly is now beginning to take notice.
As we move deeper into 2026, the silver market continues to confound expectations. After an exceptional 2025, many analysts argued that silver would struggle to repeat such performance, citing exhaustion, overextension, and the metal's long history of false starts. Yet those doubts have been decisively challenged. Silver has now pushed to a new all-time high of $84.38, far beyond its long-standing ceiling near $50 that once defined an entire generation of skepticism. For years, critics dismissed silver as a stagnant industrial byproduct rather than a monetary asset. That narrative is no longer sustainable in a market that is clearly repricing silver's role in the global financial system. It is within this context that Andy Schectman's analysis becomes particularly relevant. Andy has spent decades inside the physical precious metals market, watching cycles come and go, manipulations rise and fail, and structural weaknesses quietly compound. What he is describing now is not a retail-driven frenzy or a speculative blow-off. Instead, he points to a coordinated shift by bullion banks, sovereign actors, industrial giants, and institutional capital toward direct ownership, delivery, and removal of counterparty risk, especially in silver. Names like JP Morgan and BlackRock are no longer operating solely as intermediaries in paper markets. Their behavior increasingly reflects a recognition that physical metal matters in ways it hasn't for decades. Andy frames this moment as reminiscent of the Hunt brothers episode, but with one crucial difference. This is not about two individuals exploiting leverage in a flawed system. This time, the buyers include central banks, sovereign wealth funds, national governments, and industries that cannot function without silver. The scale is larger, the motivation is structural, and the implications are longer lasting. What was once quietly unfolding behind the scenes is now beginning to surface in delivery data, repatriation trends, and visible stress inside the exchanges themselves. In the discussion ahead, Andy also touches on growing concerns around exchange integrity, the vulnerability of ETFs, margin manipulation, and what could happen if physical silver availability tightens further. He explains why this environment looks very different from past suppression cycles, and why price setbacks are no longer having the same effect. If you value precise deep dives like this, don't forget to like this video, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate the support and hope you enjoy the video.
One of the things that when I look at the markets, there's so much noise. There's so many distractions. Even this new AI Asian guy that's blowing up all over the place, and some of what he says is fantastic. I take exception with some of it, but an awakening, an understanding, and there is a lot to take in. But to me, I boil it down to something that I've focused on pretty much nut and bolts for the last 4 years, and that started with the massive purchasing of gold and silver by the central banks. India, huge silver consumer, but deeper than that, Saudi Arabia taking big interest in silver. China, the number 2 producer in the world, flying all over the world to, in particular, Peru and Mexico, buying pre-refined silver in doré and concentrate, paying double what the West will, shipping it back to China to refine it. The central banks buying tremendous amounts of gold and silver, but removing them not only from the exchanges, removing counterparty risk, standing for delivery, but even taking their metal back from the New York Fed, which always gave access to the COMEX, and from the Bank of England, which gave access to the LBMA. An overriding theme of accumulation and repatriation and removal of counterparty risk by the most well-funded, but more importantly, well-informed traders in the world. Now, if we take that a step further, whoever got to President Trump and said, dude, if we don't bring this back, if we don't get in this game, we're in big trouble. And we've seen that now for 14, 15 straight months. We've seen massive deliveries. In December, there was 64.73 million ounces of silver issued and stopped, which basically means delivered. Doesn't mean left the facility. A good amount did leave the facility, but what it did mean was that there are huge amounts of interest that are bringing in the real metal instead of the continuation of the paper promises. That was the largest ever 1 month delivery of metal in silver into COMEX. And then we look at
Wow.
it here just in the first 3 days of the January contract, first or second, third, and fourth. We saw, what was the number here? First 3 days was a huge amount. Sorry, I don't have it at the tip of
No,
my
that's okay.
fingers, but I believe it was somewhere in the neighborhood of, yeah, by the way, 62,875, excuse me, December delivery, 62,875,000 ounces. Now, in the first few days of the January contract, we see, gosh, where the hell did that go, Ivan? Somewhere in the neighborhood of 18 million ounces of silver stood
Just in the
in the
first 3
first 3 days.
days.
In the
Wow.
first 3 days. And so, the biggest money in the world, and somewhere in the neighborhood of about 600,000 ounces of gold in the first 3 days. These are billions of dollars of both gold and silver standing for delivery in 3 days, but repetitively every single month since a year ago, November, these people know what's coming and they're front running the public and they're standing for delivery in massive amounts when it used to be exchanging of warrants, not as much metal moving. There's a good deal moving now. And that, to me, you're talking the most well-informed traders in the world see something that the public doesn't. I'll tell you what is interesting. They've raised the margins on COMEX, and that's something
Right.
that we have seen repetitively, where this is how they knock the wind out of the market. So before they raised it twice in the last couple of weeks, and before they raised it, I think before Christmas, the day after Christmas on the 26th, they raised it by 30%. The amount that you had to have was about $21,000, I think, for a COMEX contract of 5,000 ounces. Put that at $70 or whatever, you're talking what? $350,000 worth of silver is controlled with 21,000 margin. So you buy these traders who go deep on leverage to take advantage of this massive uptrend in silver. Now all of a sudden a 30% hike, you have to immediately post, instead of 21,000, you have to post about 27,000. And if you don't come up with that money, your position is liquidated. And this is how they knock the wind out of the levered traders. They specifically target the longs. So these longs will have to sell some of their contracts, let's say, if they have a whole bunch of them, to cover the margin on what they can afford to keep that selling, and the rising of the margins begets more selling, and it starts to fall down. It's called shaking the bushes. And the big money, who's been standing for delivery, who's not on margin, stands there and pickpockets all of this silver at subsidized prices. The big banks are the ones that have the book of where all of these hedges are put on, and the entry points and the pain points. And it's kind of like a house in a neighborhood, a gated neighborhood, where the houses are $50 million each. Those people who buy those houses don't care about mortgage rates. But in the areas where everyone's on mortgage, yeah, those house values are going to crumble. It's the same thing here. The big traders, the Tesla, the Samsung, the Sony, the photovoltaic solar panel makers, the sovereign wealth funds, the governments that are standing for delivery are not using margin. They don't care. And by raising the margin and squeezing the market, all of the not, let's just say, not as well funded as they need to be to play in that sandbox, traders get knocked out, shooken out. The price drops, and the big money picks it up. That used to knock the wind out of it, and it would never come back. Kind of like when silver was tamped down when you came on the scene in 2021 in January, February, and they knocked it down, and look how long it took to come back.
Yeah, years.
Well, right, and that ain't happening anymore. And now they hit it, and it comes right back. Not only do you have the arbitrage in China, where they're posting a constant $5-6 spread between New York and China, where they
Right.
are incentivizing the traders, the big traders, to buy paper in New York and sell physical in China to, in essence, capture that arbitrage. And what we're doing is we're playing right into their hands, and that silver won't come back.
Building on Andy's observations, the most striking development is the sheer volume of metal now being demanded for delivery rather than rolled forward as paper exposure. For years, futures markets operated largely as closed systems, with contracts exchanged, offset, and settled without significant movement of physical supply. That has changed. We are now seeing repeated months where massive amounts of silver and gold are being issued, stopped, and increasingly removed from exchange-accessible inventories. This is not speculative positioning. It is capital deliberately choosing ownership over promises, even when that choice requires higher upfront cost and logistical complexity. Andy also raises an uncomfortable but realistic question. What happens when retailers, refiners, and dealers simply cannot source silver at any price that reflects the quoted spot market? History shows that price declines do not guarantee availability, just as rising prices do not ensure supply. When physical tightness emerges, premiums disconnect, delivery times stretch, and paper prices lose relevance. In such conditions, the stress does not originate with physical holders, but with the structures built on leverage, rehypothecation, and synthetic supply.
So many things where you have a global rush. Now, so you have at the end of 23, the European Union says silver is a critical mineral. In November of last year, China issues a memo saying, yeah, we're going to prioritize domestic ownership of silver for our own people. Then we come out and say silver is a strategic metal. And then they say, well, we're going to limit exports. Well, this is not about two brothers like the Hunts trying to corner a market. And the interesting thing is it's the same situation. The Hunt brothers noticed that there were more paper contracts than there were bars behind it. So let's buy the paper, stand for delivery. Well, and the exchange does what the exchange always does. They change the rules or modify the rules, kind of
Right.
like they're doing here and going right after the longs. Well, that ain't what this is about anymore. This is about some of the biggest, most well-informed money in the world that is making a rush to accumulate a metal that is finally being admitted as strategic, not just industrial, and arguably worth more than the dollars used to purchase it. And what started out very quietly is now beginning to take notice. And the funny thing about this, Ivan, with all of the performance of silver blowing everything away, where the hell is the mainstream media? Where is the
Yeah.
integrity of anyone in the mainstream? Not only talking about what silver has done, but how about the fact that we are seeing billions upon billions upon billions upon billions upon billions coming into COMEX every single month? And where the hell are these idiots like Jim Cramer or any of them on CNBC or Fox saying, something's going on COMEX, because whoever is doing this to the tune of billions of dollars, well, that's not your little trader. These are the most sophisticated people in the world who don't do this for the heck of it, right? I'd like to be a little bit more profane, but I won't, because I just want the point to get across here that that's all you need to know. I mean, before that, all you need to know is, why did 8 Western banks hold the largest concentrated short position of any commodity ever traded on the 1,000+ commodities on COMEX? Why in silver? Why?
Right.
And that has to do perhaps with the military industrial complex. And that's another discussion for another time. But when you see the biggest traders in the world doing these things, seeing what they do and getting zero attention by the mainstream, you should be very keenly interested in exactly what they're doing, because it's front running, and either you see it and choose to trust it or you don't. And I think that's exactly what is happening right now. I think it tells you that we have not seen the end of this bull market for a long time with the amount of money coming in physical metal into the COMEX.
What happens, let's say, in the next year or two, when the day finally comes where the average investor can't get silver? What do the bullion dealers do? What happens when you don't have any more silver? What happens then?
That's a reality, Ivan. And I've seen it myself in periods of time that were nothing like this. In 2008, the price of silver fell from 21 to 9. It fell by 60%. Gold fell from 1,000 to 700. It fell by 30%. And you would think when that happens that people are just dumping metal onto the market. It's being overwhelmed. The price falls by 60% in silver.
Right.
But the funny thing about it was that you couldn't find for 3 or 4 months anything from the US Mint, the Canadian Mint, the South African Mint, the Austrian, none of them. The Perth Mint shut down in August that year, took no new business. The Rand Mint in
Wow.
South Africa sold everything they had for the first time in 60 years, were sold out. The US Mint was shut down 7 or 8 times in 2008. The Canadian Mint and the Austrian Mint were working 24 hours a day, 3 8-hour shifts, and were 16 weeks back ordered. And the same thing with the UK Mint, and there was nothing to get. David Morgan called me up and said, Andy, I got this relationship with this company called Pyromet. They are in the medical imaging business. They've stockpiled silver forever. They don't know. They want to get involved. They made these bars. They were the ugliest bars you've ever seen in your life. They said 100 ounces, nothing else. They didn't have AG on them. 100 ounces of what? And that's all the industry had to sell. If it weren't for David, there would have been nothing. And when the mints
Wow.
finally came back on, like in November, and said, yeah, you can place orders now, you had to pay up front. Silver was still about $9. You would pay $18 an ounce, and you would wait 8 to 12 weeks to get your product and had to pay up front. That was my entire career to where we are right now. You and I and everyone listening to this represent the pimple on the elephant's ass. We are such a small position of metal owners, people that get it. And proof positive being any of you who understand this, I guarantee you can't talk to more than a couple of your friends or your family about this for more than 30 seconds. They think you're crazy. Now, maybe not so much anymore,
Right.
but the amount of, ask Rick Rule, he will tell you that the amount of metal ownership, not just in physical, but in equity related, is 0.5% and all the way across the financial matrix. And he would always say, from Joe and Jane Sixpack to the Harvard Endowment Fund. It's funny to note that the Harvard Endowment Fund just bought a couple $100 million of gold. So look, the bottom line is this. I have always said, and people say, hey, just talk in your book, you're a shill. No, I'm not, man. I have always said this market will be identified in 2 ways, by you and I, and it's impossible to get it, by everyone who who never listened to you, said, damn, you were smart, man. Ivan, you knew I should have listened to you, but it's too expensive now, I can't buy it. They won't even have attempted to buy it. But for all of us who want to keep adding, because we see where this is going, it will become harder and harder and harder, because you have a very limited supply. And the majority of the new stuff, if it doesn't come from the US or Canada, North America, and a couple of private refineries, South Africa, Australia, Austria, the United Kingdom, everything is offshore. And at some point, if things really get tight, don't you think these countries will say, what the hell are we sending this stuff to North America for?
Right.
We should hold it here, reshore it for our own people and our own national interests. I do believe if things continue in the direction that they are going, that is very possible. Now you buy gold, you buy platinum, you do what you can do to get out of harm's way. And a lot of people listening to this will be cynical and say, yeah, he's just saying that. But be that as it may, it is what I believe, and I'm very consistent. And I say the same stuff, and I'm not in business to come on YouTube on a channel like yours that gets millions of views and say stuff that is full of crap. I believe it in my soul. Look at how hard it is. Prime example are the 100-ounce bars. For whatever reason, because of tariffs, the majority of the 100-ounce bars are made in Switzerland, PAMP, Swiss, Metalor, Argo Herreras, and then the Royal Canadian Mint and the Perth Mint. They all make 100-ounce bars, but guess what? None of the importers wanted to bring them in, and because of tariffs. So there really aren't any. The moral of the story is there are 6 major mints: US, Canada, Austria, Australia, United Kingdom, and South Africa. And when they stop or when they run out, it's game over.
One of the most misunderstood risks in today's silver market is the idea of confiscation or forced control. While speculation around green confiscation or strategic mineral seizure circulates widely, Andy makes a critical distinction. Governments do not need to chase privately held coins or bars when far easier targets exist. Exchanges, vaulting systems, and ETFs represent centralized pools of metal governed by rule changes, settlement modifications, and regulatory discretion. These structures are far more exposed to policy risk than privately held physical metal held outside the system. This distinction matters because it reframes how investors should think about risk. The greatest vulnerability is not ownership itself, but where and how that ownership is structured. Paper silver, pooled accounts, and exchange-linked products may offer convenience, but they also embed counterparty exposure precisely at the moment when counterparty trust is eroding. Andy's consistent view is that physical metal, properly held, remains the most resilient form of exposure in an environment where rules are increasingly rewritten mid-game. Beyond silver alone, these dynamics reflect broader changes across the precious metals complex. Central banks continue to accumulate gold while repatriating reserves from traditional custodians. Industrial demand for silver is rising not just because of green energy narratives, but because modern technology increasingly depends on properties that cannot be easily substituted. At the same time, mine supply growth remains constrained, capital investment lags, and geopolitical considerations are reshaping where refining and production take place. What ultimately stands out is that the market is no longer waiting for public consensus. The largest, best-funded participants are already acting, absorbing volatility, and using price weakness as an opportunity rather than a warning. This front-running of the public has historically been how major commodity repricings unfold. By the time mainstream commentary acknowledges the shift, the most important positioning has already occurred. For everyday investors, the takeaway is not urgency driven by fear, but clarity driven by structure. Silver is no longer being valued solely for what it produces, but for what it represents in a system under strain. Whether prices move higher smoothly or through volatility, the underlying trend points toward tighter supply, stronger hands, and diminishing tolerance for paper substitutes. If you found this analysis useful, take a moment to like the video and share it with someone who's trying to understand what's really happening beneath the surface of the silver market. Subscribe for more in-depth discussions like this, and as always, thank you for watching.